I'm Alan Kenny, Editorial Director with REIT.com, and joining me here at NAREIT's headquarters in Washington, D.C. is my colleague Calvin Schnure for this edition of Fundamentally Speaking. Calvin, let's start off talking about the economic fundamentals. The first half data has been pretty choppy. How's that impacting commercial real estate?
We've had mixed news on the economy. We've seen overall GDP growth being fairly weak, around 1% each of the past 3 quarters. The first quarter of the year actually was just quite weak overall. A lot of the financial market turmoil and uncertainty about the economy weighed on it. In the second quarter, we saw consumer spending come back, 4.25% growth in the second quarter. There were some pockets of weakness, business investment. Part of that's investing in oil and gas drilling. Oil prices are down, so that's not surprising. The core of the U.S. economy seems to be on track. What I'd say is most important, though, is you look at the job growth. Again, we saw job growth was fairly weak in the winter and spring, but it's since then come back. The past couple months have been above 200,000. That's a really solid job growth with rising wages. This is really going to support the economy going forward.
Okay, then how are conditions at mid-year in real estate markets?
Real estate markets have been improving. We've seen fairly steady improvement in most property sectors with declining vacancy rates and good, although sometimes decelerating rent growth depending on the sector. One sector that's on everyone's mind is the apartments. Apartment sector saw very rapid rent growth last year. It's decelerated quite a bit, and I would say that there are a couple reasons for that. One is we've had a increased new supply, particularly luxury apartments. The West Coast, the Seattle and San Francisco markets had quite a bit of new deliveries, and that has been weighing on the market. But also keep in mind you're coming off of a prior year where you had rent growth 5, 6, 7%. It's natural to have some deceleration after such a good year in the past. But overall, there's still very low vacancy rates. I'm not concerned that the market is going to be able to absorb this new supply going forward. Other sectors have also had generally positive news. Retail has had ongoing problems because e-commerce is taking a lot of store sales away. But the construction is very low as well. You look at absorption to completions, that is demand relative to supply. It's a very favorable balance that's leading to general improvement in that sector. And then there's some sectors that have just done quite well. You look at self-storage, data centers. These are sectors that are really thriving on the growth of the new economy. So overall, it's a quite favorable outlook for real estate in general.
Well, all that sounds pretty good for REITs, right?
The REITs are participating in the ongoing recovery in real estate. And one question that we get an awful lot is, how late are we in the cycle? Are we in the late innings of the cycle? And the important point to keep in mind is that demand is still well ahead of supply. Supply, new construction has increased, but demand, net absorption, is running 30%, 50% even higher than new supply across all the property sectors. So that means that on the current trends, we should have continuing tightening in the markets, rising occupancy rates. That's going to support rent growth going forward. We're seeing so far quite good results overall for REITs in the second quarter. We're mostly completed in the earnings season. And you're seeing FFO growth over a year ago in the low double digits, maybe high single digits, depending on the sector. That's quite a good performance. So overall, the REITs are continuing to thrive in this real estate environment.
Well, Calvin, thank you so much for your time.
My pleasure.
For more on this and other REIT news and analysis, be sure to visit REIT.com.